Okay, so in terms of how interest rate decisions are actually made, then what we know, well, I mean, they're made, as you might imagine, using a very large amount of information. As we said, they're made by the Monetary Policy Committee. They meet about every 6 weeks, and what they're trying to do, remember, is to bring inflation to a target. So their target is 2% inflation, plus or minus 1%. As measured by a thing called the Consumer Prices Index. So percentage changes in that. But obviously they know that if they change interest rates today, then that's not going to have any meaningful impact on the economy, for some considerable period of time. I mean, it might start having an effect, kind of within a month or two. But what they know in reality is that it takes time for people to respond. It takes time for banks to pass on interest rate cuts. Even when they do, people don't necessarily run straight out and borrow money. So what they know is that the full effect probably takes somewhere between 12 and 24 months to feed through to the real economy. Certainly, they're looking kind of at least 1 year ahead. When they're thinking about, what is it that what I do today is going to do to inflation and also to economic growth, GDP, and so on. So, what have they got to think about? Well, they've got to think about all the things that are likely to affect inflation then over the next year. And there's a whole range of possible things that are going to affect inflation. What we know by and large is that we've got factors that affect the demand side. So we've got demand pull factors and factors that affect the cost side. And the central bank's often less worried about the cost side, because these tend to be shocks which have mainly a one-off effect. So they might increase the cost of living for now, but in a year's time, then that will drop out of inflation. So if there's an oil shock, well, okay, it creates an increase in the cost of living, but it doesn't create sustained increase in prices over time. So the sorts of things that they're interested in. I mean, they are interested in that, obviously, but they're interested in facts on both sides of this game. So one of the things that they're particularly interested in is wage increases. They affect both demand within the economy. And of course, they're going to affect the cost side of the economy as well. On the cost side, they're particularly interested in things like oil shocks and other commodity price impacts, which are going to drive up production costs. On both sides, you've got things that are happening to the exchange rate. As we argued earlier, the exchange rate, a decrease in exchange rate, say, can increase aggregate demand. But also we know that a decrease in exchange rate is gonna drive up import prices. Changes in consumer confidence, and the availability of credit. Are banks lending? Those are things they're very important to the Bank of England. One of the most important factors, one of the things they're most worried about, is what are called inflationary expectations. Now, inflationary expectations are really, really important. And the reason they're so important, is that they feed into something known as the wage price spiral. And this is something that central banks, are particularly concerned about. I'll bring that back in a minute. But the way the wage price spiral works, this is how inflation is sustained within the economy. So if you imagine over here, we have labour markets and other factors of production as well. We know that in the labour markets, what happens there is that wages are set. Over here, we're going to have product markets. Product markets are it's very simply the market for products. So it's where prices are set. The prices of iPhones, the prices of broadband, the prices of marker pens, and so on. And what we know is, suppose wages increase. Suppose there is an increase in wages. Then what that does, is it leads to an increase in costs for businesses. And because businesses face higher costs, then what they'll tend to do is to increase prices. And it's worth bearing in mind that the point at which wages are most likely to be increasing is when the economy is doing well. So if there are strong levels of aggregate demand, that makes it easy for workers to get pay claims. That drives up costs. But when, of course, there's strong aggregate demand, that makes it easy for firms to pass those price increases, those cost increases, on to consumers in the form of higher prices. Of course, what that does is it increases the cost of living for workers. Yeah, so workers face higher cost of living, and they now realise that they were right. They realise that inflation is starting to build. It creates inflationary expectations, and that means they ask for an even higher wage increase. So when the central bank is thinking about what impacts inflation, these are some of the factors that it's going to take into account. So essentially, then, anything that affects aggregate demand, anything that affects costs, those are the sorts of things that the government's going to take into account. Other things that they might care about is what's the government doing with fiscal policy. So if the government is using an expansionary fiscal policy, then we know that's going to increase aggregate demand, and that therefore that would be likely to feed into inflation. On the cost push side, things like indirect taxes. So what is the government doing with, say, VAT? Because we know that changes in VAT, they immediately feed into the level of inflation. They're going to be interested in economic growth in general terms, because again that directly feeds into household incomes, which will again increase aggregate demand. So really, anything that is on the one hand impacting total demand in the economy, confidence, consumers building up debt, all those sorts of things, the impact of previous interest rate decisions for that matter, and anything that affects costs, those are the things the central bank takes into account. Thinking about it, remember, over at least kind of 1 year period. In other words, they are trying to forecast what's going to happen. The fact that inflation is high now doesn't in and of itself mean that inflation will be high in the future. And therefore, you'll sometimes get the what on the face of it might seem to be slightly strange interest rate decisions, because you might say suppose that's time, and suppose that's inflation, and suppose that's your 2% there, and suppose that inflation's kind of been doing this, we'll call that 3%, and that's 1%, so at this stage here, you'd be saying, well, look, inflation's up at 4%, and surely the central bank should be increasing interest rates. Well, maybe not. Not if they're thinking, well, look, that's my trend, and what I'm thinking is that in a year's time, so that's now, and that's say in a year's time, they might be worried that in a year's time, actually, there'll be a danger that inflation is dropping out of the band. So what they might do is it's possible that they could cut interest rates even when inflation is above target, because what they're interested in is what the trend is going to be over the next 12 months.